All right, so welcome back in today. We're going to be jumping into, of course, the latest news on how the debt ceiling may affect markets in general. We'll take a look at a deep dive also on some other aspects of the technology sectors that are starting to make some moves, mainly because of what we've seen with AI, with Nvidia, obviously Apple getting ready to make their big announcement. So there's a lot of traction right now in the tech space. We'll find out if that has detached away with a special guest today. I think you guys are going to like this one. My name is Paul Barrow. Welcome back into Tech Path. Joining me today is Lyn Alden. Great to have you back. We've had you on how many times? I think 3 or 4 times now.
Yeah, at least a couple or a few. Happy to be on again. Thanks for having me.
Yeah, excellent. If you guys have not followed Lyn on Twitter, make sure and do that. Just go over there, and of course, you can catch her at Lyn Alden Contact right there. Pretty easy. And also visit the website because there's a lot that they have going over here in terms of investment strategy. You can join the free newsletter. There's a lot of different things you can do, and of course, I'm on your newsletter, Lyn, so I'm a big fan of what you guys are doing. So good stuff over there.
I appreciate that. Thank you.
Yes. So let's get into a couple of points here today. And I wanted to kind of hit on obviously late breaking over the weekend. McCarthy, Biden, they come to somewhat of a handshake deal in reference to the debt ceiling. I was looking at this tweet here by Kobeisi. Interesting. Most ironic part of the debt ceiling deal is it will literally accelerate the federal debt crisis potentially now here. Now we have an uncapped debt ceiling for 19 months and there's going to be unlimited borrowing capacity. So I look at this and I don't know if this is a win or a loss. I'm not sure how to take this. What do you make of this, and what do you think the markets are going to do in terms of a response?
So I think it's some of an inevitability rather than a win or a loss. As far as that specific tweet goes, they talk about unlimited borrowing capacity. One thing to keep in mind is that spending is still determined by Congress,
Mm-hmm.
right? So just because there's unlimited borrowing capacity doesn't mean the Treasury can just borrow unlimited money and spend it. All the different authorizations are authorized by Congress. And so basically the how much is borrowed and spent will largely depend on the things that are already locked in. That's most of it, as well as anything that Congress decides to add or subtract, along with the president signing it.
Right.
Basically that's unchanged. That's also why most countries don't have a debt ceiling because that it's like a almost a separate thing versus the actual spending authorizations, which are done by that country's political body, whether it's a Congress or Parliament or however they tend to operate. So going forward, I think it's largely unchanged. These proposed spending cuts are basically token around the margins. They can affect individuals that happen to be in the crosshairs of those, but in a macro scale, these are not very significant spending changes. And so the long-term path towards large, ongoing structural fiscal deficits is basically unchanged. And I think that all else being equal, that is a background inflationary force.
Mm-hmm.
Um, that's kind of when you have these large fiscal deficits, that's basically a source of new money coming into the economy that wasn't previously in the economy. And so when we look at the inflationary decades over the past century, most people think of the 1970s, but that was really driven by demographics and bank lending more so than fiscal, whereas the 1940s were more driven by fiscal and not really driven at all by bank lending. And so far in the 2020s, the inflation we've seen has been due to large monetized fiscal deficits, whereas bank lending levels have been normal. And so I think that this is an ongoing inflationary backdrop, which can then, to varying degrees, be offset by monetary tightening, contractions in credit, things like that. We'll see what magnitude they want to push it, but this is kind of a key source of inflation. And a final point I'll make is that when we go forward, we look over the next 6 months or so. A challenge is that this raising of the debt ceiling can actually be negative for market liquidity depending on how they handle it. And what I mean by that is if you look over the past 6+ months, the Federal Reserve has continued doing quantitative tightening, but during that time frame, the Treasury was offsetting a lot of the Federal Reserve's tightening. They were actually pouring money into the economy because they had previously built up a very large cash balance. And they had to bring it down to their normal baseline, which is about half a trillion, but then due to the debt ceiling, they had to bring it down to almost zero. And so actually they were kind of pushing excess liquidity into the market, kind of against their will, and that actually offset quite a bit of the Fed tightening. And so the challenge going forward is that if the Treasury were to refill their cash accounts or even just hold it low, they're no longer depleting it because it's already depleted. Um, that's actually a source of liquidity that the market has had for 6+ months. It's no longer there. And so we have an environment where the Federal Reserve is still doing quantitative tightening. We have to start kind of paying close attention, I think, to the health of the Treasury market to see how liquid that remains. We have to look to see as they issue all these bonds and as they potentially refill their cash account, the Treasury, we have to see where does that liquidity come from. If it comes out of bank reserves, that's a really bad thing. But
Hmm.
if it comes out of reverse repo, then it's pretty liquidity neutral. And so there are some, I think, kind of landmines ahead to watch.
Interesting. All right, I was looking at your tweet here. It says everyone is focused on the debt ceiling itself. Next question to ask, obviously, is what happens if the debt ceiling is lifted? And you're kind of hitting on that very point in terms of liquidity in
Yes.
general. So, explain the impact on markets. How would markets respond to worst case scenario in terms of liquidity right now? How does that play out, whether it's Wall Street or even on the risk asset side, Bitcoin,
So I think
Ethereum, et
I think
cetera?
the first half of 2022 is instructive there. So the market kind of peaked. Many markets peaked in late 2021, around
Hmm.
that time frame. And if you look at that chart you have in your screen, the Treasury General Account went from basically empty. So the blue line went from basically empty, and then it shot up to nearly $1 trillion. And that was while the Fed balance sheet was basically flat. It was like topping out. Um, if we have a similar environment where the Treasury General Account tries to go up while the Fed balance sheet is going down, you
Hmm.
might have a similar negative dynamic that we saw for the
Right.
first half of 2022 in terms of asset prices. Now, I don't think it'll be maybe the same magnitude because going from 0 to 1 trillion TGA is unusual. Their target is about half a trillion. I think there were also might have been geopolitical decisions were made in that. I think they were kind of purposely trying to strengthen the dollar and kind of crush oil prices and things like that.
Hmm.
So I think that some of those things are aside, but I think that's kind of the overall framework we have when looking at the combination of Federal Reserve either no longer loosening or outright tightening as they are now, combined with the Treasury also tightening. So that first half of 2022 is kind of the danger scenario. And we have to see to what extent things start to look like that in terms of these liquidity dynamics, or if they deviate, if they're able to suck liquidity out of the reverse repos, then maybe we can avoid that scenario. But I think when it comes to setting
Okay.
expectations or identifying risks ahead, that's kind of the key thing to watch.
All right, so you outlined a few things there. I wanted to, there are some parameters I think that will get affected here in terms of surrounding sectors. If you look at the banking industry, we've continued to see a little bit of a flight of capital going into everything from money markets, et cetera, that have been able to do quite well. But you also look at what's happening within the situation around commercial real estate, all that starting to play into it. And then the coming recession, most likely, whether it's a soft recession or a hard cut, could time-wise be right in the middle of what you're talking about. How would those markets or those particular situations be affected as well? What should we be watching for?
So I think you point out that this is kind of the whole danger zone, and they can feed off each other. So better liquidity conditions can actually help accelerate the economy, and very negative liquidity situations can slow down the economy. And so I think that the risk we face going forward is that, you have these kind of tight liquidity situation at a time when we already see a number of economic indicators decelerating.
Mhm.
And so I think that puts a lot of things at risk. Now, there's kind of a Boolean outcome here. So I think the path forward is we have to assume kind of weaker or stagnant sideways markets for a while in a broad range of asset classes until we see signs otherwise, right? So the kind of the Occam's razor approach is not looking great. But then if, say, something breaks, let's say the treasury market goes illiquid and it requires another liquidity injection, that's a pivot point that we then need to adjust for. So I think that the essentially the path here is stagnation, liquidity problems, then reversal, then higher. But I think that it's hard to navigate through because these are a handful of centralized people making decisions, right? So
Mhm.
instead of just looking at a system that's kind of operating on its own, we'd have to see how well certain individuals, like the head of the Fed, the head of the Treasury, how aggressively they going to work through this, or how kind of softly are they going to try to navigate without causing another banking crisis? And so I'm sticking to a pretty diversified portfolio at this time where I have various cash equivalents that are kind of protection against, deflationary kind of crashes, liquidity problems, that kind of thing. But then I also still have my longer term structural bullish assets that I like to own that I'm also willing to rebalance into should we get, you know, the kind of the worst case scenario of market turbulence.
Yeah. I'm going to take a look at, for those of you guys watching right now, we're going to take a look at Lyn's growth stocks and some of the assets she's talking about there. Before we get into that, I want to talk about this right here. JP Morgan predicts Bitcoin possibly revisiting the 45K mark. And this would be in a scenario where gold is also rising as an asset class in terms of price and value. You look at Bitcoin and gold right now, along with what's happening here with the debt ceiling, what we know of the liquidity scenario that might be painting out within the markets, what would be the best play here for an average investor that's trying to diversify their portfolio right now?
So I like both gold and Bitcoin as part of a diversified portfolio. Kind of the framing that I use for a diversified portfolio at the current time is a three-pillar portfolio. So one pillar is cash equivalents of various types. That can include things like T-bills, money markets. Um, Another pillar is long-term compounding equities. So equities
Mhm.
you're happy to hold for 5+ years. They could be dividend payers. They could be kind of profitable long-term growth stocks at reasonable valuations. Um, that's kind of historically a very attractive place for long-term compounding. And then the third pillar would be basically commodity exposures or hard monies, which is more of an inflation hedge. So that can include things like energy companies, copper miners, direct
Mhm.
commodity exposure, like holding a uranium trust or something like that. But then also would include assets like Bitcoin and gold that are, protections against ongoing currency debasement, potentially superior monetary systems that are gaining adoption over time. And so when we look at, let's say, like $45,000 price targets, if you look at Bitcoin's price action historically, it's very correlated with liquidity. And
Mhm.
there's various ways to measure liquidity, but essentially, for example, if you look at global broad money supply and then denominate it in dollars, and you look at that in year-over-year terms, that's very correlated with Bitcoin. So when that's going up, usually Bitcoin is having one of its big bull markets. And obviously, there's two big drivers of global dollar-denominated M2 broad money, which is either you get a big expansion of money supply itself, or you get a weaker dollar because that's the unit of account that you're measuring all these in. So if you get a stronger dollar and you get ongoing quantitative tightening, that's generally rough for Bitcoin. And if you look
Yeah.
at this big kind of mini bull run we've had, where Bitcoin came off its lows, nearly
Mhm.
doubled. Um, the dollar peaked back in the autumn, the dollar index. And because we've had the Treasury general account pouring money back into the system and offsetting the Fed, that coincided with somewhat of a bear market, or at least a cyclical bear market in the dollar, which has given a bid to assets like, Bitcoin, gold, things like that. And so I think the next, say, 6 months, next 12 months are really going to highly depend on liquidity dynamics, which again will come down to a handful of people. But if you ask me what I think Bitcoin looks like in 2 or 3 years, and probably gold as well, I think that's a clearer picture. And in that time frame, I'm certainly a bull.
Okay. All right. Good. Now let's talk a little bit about, because there seems to be a little bit of a shifting narrative here right now, both from Wall Street, but also from the tech community in general. This time last year, AI was still in the emergent phase. We weren't seeing as much movement in the VR space. Meta was still thinking metaverse was going to be their strategy. So we've seen a lot pivot in 12 months. If you look at Raul Paul, he has kind of indicated a couple of things here. Biggest and most persistent macro trend on Earth is the one that gets the most pushback from many. This is the exponential age of technology. And that's his theory, is that there's so much growth moving in the tech space right now. Are we maybe seeing another era of growth, not only growth stocks and projects, but also technology itself that could feed into the rest of the markets, new startups, all sorts of companies that could pivot in those directions, whether that's AI, VR, AR, et cetera, going this direction, obviously with blockchain moving into this as well. What are your thoughts on that in terms of, I know you have a fairly good consistency within some of your growth stocks, but what is your thesis on how tech plays out over the next few years?
So I think we can kind of break that into three components that then when you solve them individually, you can kind of put them together into a whole. So one is the underlying growth itself. The second one is valuation contractions or expansions for those equities on that growth. And then the third would be just baseline monetary debasement. So what is your unit of account doing? And an example is the Nifty 50 stocks. So from the late
Hmm.
1960s, there was a bunch of these stocks that it was argued that you could do no wrong by holding these. These were stocks like Disney, Coca-Cola, Xerox, all these kind of structural blue chip growth stocks of the day. And they ended up fundamentally doing very well over the next 15 years. So they grew through the 70s into the 80s. In aggregate, they did wonderful performance, but they were kind of dead money for like a decade or more because the valuation was too high. And partially what influenced that valuation was in the 60s you had at least until the end of it, you had kind of lower inflation, lower interest rates. That allows for very high equity valuations. But as they obviously entered the late 60s and then into the 1970s, they had more inflation from commodity constraints and things like that. They had higher interest rates, and that put a lot of valuation pressure on those big kind of long-term growth stories. And so I think the challenge here is that the long-term growth of at least some of these companies is very significant. So I think that's in their favor. I also think monetary debasement longer term is in their favor. So the unit of account is just going to continue deteriorating over any kind of 5 or 10 year stretch. Um, the part I would be more concerned about that I think could be somewhat of a headwind is this valuation pressure, because if we enter a decade where we have more commodity constraints in general. So not every year, but in general, we're no longer super abundant in terms of, say, energy production, copper production compared to our demand. You're more likely to get these spurts of inflation, higher yields, that kind of problem. And historically, whenever you have those just tighter commodity environments, so whether it's maybe the 2020s, the 2000s, the
Hmm.
1970s, the 1940s, kind of like those types of decades, that tends to put a lot of pressure on growth stocks because it's harder for them to have that really high valuation because they're competing with the fact that the raw materials and their quote unquote risk-free counterparts like treasuries are at higher yields. And so it just puts valuation pressure. So I think you have to be kind of selective and sober when thinking about the say the 2020s performance of some of these names. I think that there will be winners, there will be losers. But you have to make sure you buy at a reasonable price if you expect to hold long term and make money.
Yeah, yeah. I was looking at your M1 Finance breakdown on your newsletter, the multi-asset portfolio. And I was looking at the growth stocks. This is 12% holding in there. You've got Amazon, Adobe, obviously making an AI play here recently, Alphabet, Google, still in a strong position. MicroStrategy, obviously the Lightning Network and really the opportunity there within Bitcoin. And in general, do you think of anything else that might be added to the growth stocks down the road, or are you pretty comfortable with this set that you're working on right now, or is there anything you're looking at?
So I rotate over time as valuations get more or less attractive. And I also consider certain things like geopolitical challenges, right? So if you have a growth stock but it's heavily reliant on Chinese supply chains, you have to kind of
Right.
weigh the risk of a kind of a tail risk happening to that in the next 5 or 10 years. Um, I think that let's say Nvidia, for example. So Nvidia is a currently popular growth story, but I mean it's screamed vertically higher,
Hmm.
very high valuation. I think it can grow into that valuation over time, but I wouldn't chase it here. I think an interesting story is Taiwan Semiconductor, because
Hmm.
who makes Nvidia's GPUs? Well, it's
Yep.
Taiwan Semi. It's trading at half the valuation as Nvidia is. One of the risks of Taiwan Semi is, of course, the geopolitical tail risk I just mentioned, that it's based in Taiwan for the
Right.
most part, and they're trying to
Yeah.
gradually expand elsewhere, but the core of their operations are still there. Well, I think investors have to ask themselves if Taiwan Semi has somewhat of a discount due to tail risk, shouldn't Nvidia also have kind of a tail risk discount that we say, okay, structurally, I don't think anyone doubts that Nvidia is going to be making way more GPUs 5 years from now than they are now. The question is, what price should we pay for that now? And then two, can they get disrupted for say a 1, 2, 3 year period
Exactly.
at any point in there? So I actually think that it's possible that Taiwan Semi is a little bit undervalued and Nvidia is a little bit overvalued because I think one is carrying all the geopolitical risk, even though they both kind of are tied at the hip there. So I think there are idiosyncratic kind of company-specific risks that you can find that are underpriced, other ones that are probably at least in the kind of an intermediate term overpriced. Um, but I think focusing on things that have long-term compounding potential are attractive. And actually, they're not all equity based. I mean, I still think Bitcoin, even though it's not an equity, I think it has certain growth stock characteristics in the sense that you're buying into the idea that this protocol is going to be more important 5 or 10 years from now
Hmm.
than it is now, and that therefore you can have your slot on the network. So I kind of also consider that one of my growth holdings.
How would you rate, though, Bitcoin, from a geopolitical risk standpoint? It was a good example of, Taiwan Semi versus with Nvidia and a supply chain potential conundrum that kind of faces that. You could also look at Tesla with what they have to have in terms of battery constraints worldwide, globally. So there are variations within some of these major tech companies out there that do play into those geopolitical risks. What about Bitcoin?
So I think in that regard, Bitcoin has less geopolitical risk. If anything, it's kind of insurance against certain geopolitical risks. So one of the major selling points of Bitcoin is the idea that you can self-custody money and then you can bring it anywhere in the world with an internet connection,
Hmm.
which, as an American doesn't seem super important on its surface. But if you live in Lebanon, if you live in Argentina, if you live in China, if you live in India, if you all these different Nigeria,
Yep.
the billions of people in the world that are in either smaller countries, more inflationary countries, more authoritarian countries, any just time they might want to, for whatever reason, bring their assets around. It's Bitcoin is the least friction asset to be able to bring with you. Other ones can get blocked by all sorts of capital controls and frictions and confiscations and things like that. So I think that's actually a point in its favor. Number two is that it doesn't have profits. It's a network, right? So there's tail risks on the network, like the United States going hard on it. There are these certain challenges that it can face, and it probably will face to some degree in the years ahead. But for example, if you were to have some of these tail risks, like China and the United States have their relationships break down, these companies with very big installed asset bases in China,
Hmm.
like Apple or Tesla,
Right.
things like that, I'd be more worried about those assets because they're at a pretty high valuation. They have this tail risk that could be their operations, like, just absolutely massive damage. Whereas the Bitcoin network is more nimble, more decentralized, not reliant on profits. So if you do get that kind of war or that kind of breakdown scenario, I think Bitcoin would be volatile. And I think that the biggest risks kind of against it are, say, US or European capital controls, them viewing it as a threat. But I think as part of a portfolio, I think it actually has a different risk profile than you get with some of these other growth stocks, even though itself is a growth technology.
What do you make of ordinals? When you look at, I mean, let's talk about Bitcoin. Obviously, we saw a lot here at the Bitcoin conference. Saylor's been on record, obviously, his involvement with Lightning. The option here of where ordinals plays out in Bitcoin's future. Also, latest news here, ordinals to bridge now to Ethereum NFTs with their launch of their BRC 721. So there is some things happening within the space. Where do you stand on this position right now?
So I think we can separate it into the two parts, which is inscriptions and ordinal theory.
Hmm.
Putting arbitrary data in the Bitcoin blockchain has been there since the beginning.
Yep.
It's had various forms along the way. It's had periods of being a fad and then going away and then coming back in a different form. So I do think that, kind of another way of framing Bitcoin is that it's the world's most decentralized and immutable database. Um, it's basically a true time chain. Unlike a proof of stake network, it's basically the combination of small nodes and proof of work makes it this kind of like digital time capsule that's pretty interesting. And kind of hard to forge. It's resilient against even like network-wide disruptions, things like that. And so I think it does make sense that there's a variety of things you might want to put in there. I mean, someone put a picture of, that famous picture of the guy standing in front of the tank in China, right? So
Oh,
maybe
okay.
there's
Yeah.
moments of history you want to record. Maybe there's key books you want to record. You want to put 1984 in there. You want to put
Hmm.
the U.S. Constitution in there. You want to put, kind of documents that might be relevant in the future that you want to make sure that maybe in the future it's hard to get your hands on untampered versions, right? And you say, well, this is
Yeah.
you can't prove that it's true, but you can prove that it's unchanged.
Yeah.
if you stick it in there and years go by. And so you can even put in other things like, just applications, code. If you want to preserve a certain type of code, if you want to prove, Michael Saylor used the idea, if you want to use Nostr, but a million AI spin up their own keys, you could, put your public key into the Bitcoin blockchain, say this is
Yeah.
you, and not a million of them can do that, or at least not in a rapid period of time. There's a cost, there's a micro cost or a moderate cost associated with doing that. And so I do think that Bitcoin blockchain is useful in that sense for non-transaction data. As far as ordinal theory specifically, I mean that's somewhat separate than just putting inscriptions. That's a claim on ownership. It's basically a way of ordering satoshis, ordering the smallest component of the network. Um, I'm not a huge fan of this kind of speculative fervor we've seen. I think that this is somewhat spammy, but I think it's burning itself out already. Maybe we'll have more waves of it in the future. But I think that there is a human urge to collect. That includes digital collectibles. And if there is a wide enough consensus on what constitutes ownership, then that can work for periods of time. I personally find that angle less interesting. Whereas I do view the Bitcoin network as a verification medium to be of usefulness. So
Hmm.
whether it's decentralized identity, like DIDs, or
Right.
whether it's kind of the Sailor example of using it to put a key document or a key burning one side of your key pair into it to prove that there's a cost associated with it. I think that is worth exploring, and it's not the first time it's been explored.
Yeah, and I think, we saw a lot happen here at the Bitcoin conference in Miami, going on both sides of it. But I would agree that at least there's conversation going into it, much like what you just outlined there in terms of real use case. So we'll see how this plays out. Maybe it does start to wane, or we might see a resurgence there. A good thing is the miners are benefiting from this, which is a good thing, from the health of the network. So that in itself will kind of blend going forward. Last point I want to make or hit on is, this idea of the tech that we're seeing right now starting to detach away from the rest of the S&P 500. If you think about what Cathie Wood did over at ARK, she still is looking at, because obviously they did a big exit on Nvidia right before it did this massive pump. But Tesla is still her AI play. When you look at those kinds of scenarios right now, I know you've got a handful of growth stocks, but are you looking at anything that is at least somewhat exposed in the AI space as well as VR? Because now with Apple and Meta seeming to be on a collision course for a race for VR, how do you play those out as investors are starting to look into that sector?
Sure, I think there's two ways to look at it. The first way is the positive approach, and the second way is the negative approach. So to get the negative approach out of the way, one thing to ask is what's going to be disrupted by AI,
Hmm.
and avoid that, right? So sometimes a trend you don't have to participate in directly, or it's not your only concern. It's also what can I continue investing in that's not heavily hurt by it? So I think for example, a theme that I've been emphasizing is that for decades now, people generally underestimate software growth and how impressive software would be over a multi-decade time frame, but they overestimate hardware growth. And by
Okay.
that I mean any engineering system that interfaces with the real world. So we overestimated what space travel and commercial air travel would look
Hmm.
like. We overestimated how quickly we'd have like robots and flying cars and things like that. So anything that kind of interacts with the real world, it runs into physics. It runs into trying to navigate this this entropic world we live in. That's always harder than we expect and slower than we expect, and not really exponential and Moore's law. It's kind of these more step changes that happen. And so I'm kind of going under on any sort of like anything that kind of really has to interface with the real world. That's more of like a longer grind. Um, and so, I think that commodity exposures, infrastructure exposures, they're still mostly unchanged in an AI thesis world.
Right.
At least, talking about investable time horizon 10 plus years. Um, it's mainly like the kind of the administrative stuff that I think is prone to disruption. So if you can anything that's like overhead, I think is prone to disruption and streamlining and improvement. Basically, their margins are AI's opportunity. Um, then when we get into like what is positive for AI, I mean, obviously, the picks and shovels plays is companies like Taiwan Semi or Nvidia, The Nvidia side, I think, is already kind of fully priced in.
Mhm.
I think there may be other opportunities there. And then from there, I think the next question to ask, maybe the play that's not fully crowded yet, is to ask, what becomes way more accessible now that this technology exists? And an example I've used is that, say, Adobe Photoshop is a fairly advanced piece of software. It takes a good amount of training and experience to use it properly. It's not rocket science, but it does
Right.
require a decent amount of training, and that's true for a variety of their products. It's also true for engineering software, coding software. These things all take kind of training and skill to use properly. And one thing that AI does is that it takes a lot of the tedious parts and makes them way easier, right?
Right.
So
Right.
we already seen in Adobe, for example, you can like circle something and say, okay, I want to add like this to it. It's like text-based commands. And you can have
Mhm.
verbal commands, you can have text-based commands, say this is what I want the picture to look like. And the AI can give you options, and you can go back and say, okay, I meant to do it like this instead. Like you can basically um, have a lot of the detailed abstractions pulled aside, and that's true for engineering design, that's true for coding, that's true for videos, that's true for art. Um, and so what I think it does is it makes all of these types of things 5x or 10x more accessible, right?
Right.
So obviously there's still a component where if you're a trained person, you're going to be more effective at the software than someone who's not trained, but the floor that you need to be effective with it is way lower now. And so a far greater number of people can use these types of programs in the years ahead. And so I think that's a story that's I'm not seeing covered as maybe as enough of it should, is that I think we're going to see like existing brands, existing aggregators whose products
Mhm.
are maybe workable by 5 or 10% of the population become workable by 20 or 50% of the population, and that in general the creator economy across all media, so art, storytelling, programming, engineering, that becomes a bigger pie that more people can do, and that the tools that serve them have now a bigger market.
Yeah, I think you hit on it. The accessibility there, opportunity from an opportunistic side of things, is really going to be pretty significant. We were showing a tweet there by Beeple in reference to your very statement around Photoshop and just the advancement that they are going to be making, likelihood of really kind of supplanting what a lot of people have been trying to do from just cobbling a lot of different tool sets and these AI agents together to try to do these things. So to your point, there's going to be some plays out there of existing companies that enhance, start to grow, to your point, getting a much larger base, especially in the narrative. And I think I also agree with the narrative of the administrative side. That would be the disruption side for sure that I think plays into this. Your insights are always great. I love to chat with you and kind of get inside your brain a little bit on understanding where the markets are going. A lot of different angles in which, if you're looking for more of a diversified portfolio, you guys should check out Lyn Alden's website. Just go to lynalden.com and you'll learn a lot more there. Lyn, thanks so much for stopping in today. We appreciate it.
Thanks for having me. Always happy to be here.
You bet. All right, so you guys are tuned in to, of course, maybe the podcast side of things. And, sometimes on the podcast, you don't get the full visuals of this because we're usually doing some switching and showing you some different screens and charts. Make sure and jump over here to the YouTube channel and subscribe here because that's going to give you all the visual effects, a lot more content that will help you understand the narrative a lot of times of our interviews. Make sure and do that because it makes a big difference versus when you're just listening to it. I know sometimes it's better in a podcast, and we appreciate all that, but just another idea, jump in there. If you guys are not part of our Diamond Circle, make sure and get in now. It's our own email list that helps you get additional content, podcast, as well as even video breakdowns that we do on charts and all that good stuff right there in the Diamond Circle. We've got some cool stuff coming up too. We'll announce later this week around the Diamond Circle, so make sure and jump in. Of course, if you want to catch me, it's out there on Twitter @Paul Barron. We'll catch you next time right here on TechPath.